Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA Edge. I review all of last week's industry news and stories and select the most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story is last week, the DOL's PTE 2020-02, making IRA rollovers a fiduciary act, will be enforced, jeopardizing a significant percentage of many wealth advisors' revenue. In 2018 alone, there were $516.7 billion in rollovers. The expansion of the best interest protection requires all advisors to acknowledge fiduciary status when recommending an IRA rollover, with written disclosures to clients about differences in fees, especially potentially higher fees of retail funds, which may be caused in part by plan sponsors subsidizing some of the administrative costs. Advisors are also required to consider the long-term and economic impact to clients and the appropriateness of the IRA rollover suggestion, and adopt and implement policies and procedures with annual reviews. Next up, sales of annuities, maybe. As the so-called DOL fiduciary rule enforcement begins, the ICI published a report showing the vast differences between the costs of retail funds versus 401k plans. For example, at the end of 2021, retail equity shares cost an average of 113 basis points, which is 3 times more than what's the average in 401k plans at 36 basis points, and that's down 50% over the last 21 years. Hybrid and institutional funds are even lower priced, and the use of CITs is driving down fees even in the small size plans. The ICI offers excellent illustrations to show plan sponsors and participants who will also likely pay 5 to 10 times more for advisory fees on top of the cost of the investments. Next story is a question that the Pew Research asked: are IRA rollovers a ripoff? Their research showed that investors lost an estimated $45.5 billion in 2018 alone by rolling into IRAs, which is obviously over the life of the investment. Wealth managers whose IRA revenue is at risk will argue they provide much higher levels of service, but along with the significantly higher cost of the investments, RPAs are starting to offer, as part of the plan, financial planning services to clients. And plan sponsors are also more willing than ever to retain assets. This could be what is known as an oh-you-know-what moment for the wealth management industry, with billions of dollars of revenue at risk, just as the stock market and advisors' fees continue to plunge. During 2008 and 2009, the Great Recession, we saw thousands of advisors come into the DC industry as a way to hedge against their wealth management practice. Next story is, unlike with the Trump administration, the Biden DOL is vigorously defending their fiduciary rule in court, with a lengthy response to a Florida lawsuit filed in February by the American Securities Association, led by Raymond James CEO Paul Riley. A Texas lawsuit is also pending, to which the DOL has not yet responded. The ASA suit claims that the DOL guidance averted the required notice and comment process a claim For Us All has made against the DOL in their suit for the DOL's cryptocurrency guidance. Industry experts do not expect the Biden rule to be vacated, just as the Obama rule had been before. And then the final story is, can Investnet lure advisors into the 401k market? With the purchase of 401kplans.com, a digital marketplace, and access to over 100,000 advisors, Investnet is as well positioned as anyone, especially with their 338 services and links to pet provider Salus. So far, wealth managers have been reluctant, but the potential loss of IRA rollovers, as well as the expected boom in small plan startups due to government mandates and incentives, maybe, just maybe, we'll start seeing more wealth advisors working with 401k plan, even if it's not their focus. Using Yodlee and AI, Investnet plans to show advisors which of their wealth management clients own or run a business, as well as find wealthy participants in the plans that they do manage. So those were the 5 most important and interesting stories from the past week. I listed a few others. Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking to you next week on 401k Real Talk.